If you travel through any Tier 3 or Tier 4 town in South India, Erode, Madurai, Nellore, Karimnagar, you will see a pattern. Tiny shops, modest homes doubling as workplaces, micro-entrepreneurs running small-scale trades. And yet, almost all of them struggle with one thing, formal credit. Banks say, documents नहीं हैं, income proof clear नहीं है, collateral है, पर cash flow समझ में नहीं आता. Into this massive unmet market stepped a company that quietly built one of India's most profitable lending franchises, 5-Star Business Finance. This is not a fintech story, a digital lending story, not even a microfinance story. This is the story of a company that went deeper, earlier and more systematically into the small secured business lending space than almost anyone else. Using a high-touch, hyper-local model, a dense branch footprint and underwriting discipline that even banks struggle to replicate. The problem 5-Star saw early. India has more than 63 million micro-enterprises and over 94% of them are proprietorships. Almost 99.5% of India's MSME universe is micro. Tiny shops, household-run units, informal businesses. Most of them need only Rs 2 to 10 lakh to expand. Buy equipment, renovate a shop, add inventory, set up a second counter, start a new service line. But banks rarely lend to this segment because borrowers cannot offer formal income proof. Often, sales are in cash, bank statements don't reflect the business accurately. No GST returns or audited financials. This phase documentation checklist of most banks. Highly localized cash-driven businesses. Understanding them requires visiting the shop, speaking to neighbors, suppliers and observing the actual cash flow, something banks are not equipped to do. Ticket size is too small. Rs 3 to 4 lakh loans are not profitable for large banks after staff costs and compliance overheads. Repayment discipline varies by locality, not by credit bureau score. In such segments, character assessment, not paperwork, determines credit health. This requires local presence and deep familiarity with customers. This unmet gap created an enormous opportunity. Most micro-entrepreneurs were not bad borrowers, they were simply undocumented borrowers. 5-Star saw this early. The pivot that created a category. Although 5-Star was incorporated in the 1980s as a very small lending company, the real strategic shift happened in the mid-2000s when it deliberately moved into the single, sharply defined product. Small, secured business loan backed by self-occupied residential property, SORP. While the reason for this pivot is not known, it seems that this pivot happened during the tenure of Mr. Anandan, who was for very long the executive director of Cholamandalam Finance and later promoted the highly successful housing finance company, Aptus, which serves similar customer demographic and focused on the same geographies. This model was pioneering because it blended the safety of housing finance, SORP collateral with conservative LTVs, with the high yields of business loans. Underserved customers, higher risk-adjusted pricing. Other NBFCs either did home loans or LAP or unsecured microfinance, but hardly anyone in that era focused on small-ticket, fully secured loans for tiny businesses in small towns. This clarity became 5-Star's biggest differentiator. The borrower profile, a gap no one else served. From the extracted prospectus-style document, we see the typical 5-Star borrower, a self-employed micro-entrepreneur, a kirana store owner, tailor, mechanic, small trader, provision shop owner, runs business from home or from a very small rented shop, has a two-wheeler loan or small MFI loan, but has no access to formal credit beyond Rs 50,000 to 80,000. Needs Rs 2 to 10 lakh for business expansion, owns a modest self-occupied home which becomes a collateral. This segment was previously served by local moneylenders, chit funds, informal financiers. At interest rates far higher than NBFC rates, the demand existed, but formal lenders did not know how to assess it. 5 Star's insight was simple. If we are present locally and can assess the borrower's business by seeing it with our own eyes, we can lend safely. This was not a technology insight. It was field intelligence. The hyperlocal model. 5 Star's real moat. Number 1. 100% in-house sourcing. No DSAs, no third-party agents, no outsourced collections. The same branch officer who sources the loan usually also manages customer relationship and collections. This ensures strong incentive alignment, accurate assessment, lower frauds, deep borrower understanding. Number 2. Multi-tier cash flow-based underwriting. The credit evolution includes residence visits, shop visits, talking to neighbors, suppliers, business cash flow reconstruction, property ownership and legal verification. This gives 5 Star's superior on-ground intelligence that cannot be replicated by banks or digital lenders. Number 3. Conservative collateral practices. Loans are secured against self-occupied homes, not investment properties. Average LTV is very conservative, ensuring strong downside protection. Number 4. Dense branch network. 5 Star has grown through contiguous expansion, expanding from Tamil Nadu to adjoining southern states before moving northward. This created a branch footprint that is far denser than most competitors, giving 5 Star better local knowledge, lower operating risk, superior recovery capability, stronger customer relationships. A local branch officer often knows an entire neighborhood's cash flow patterns better than any centralized underwriting system. Number 5. Collections are relationship-driven. Unlike MFIs, which rely on group meetings, or banks, which rely on ECS or NACH, 5 Star's approach is high-touch and personalized. Borrowers repay because the branch is 2 to 5 km away. The officer who gave them the loan comes regularly. Relationship is strong. Collateral is their own home. This mix of psychology plus security plus proximity leads to very low NPAs, consistently below industry levels. Geographic concentration. A risk and a strategy. 5 Star's book is heavily concentrated in 4 states: Tamil Nadu, Karnataka, Andhra Pradesh, Telangana. This is often labeled a risk, and it is, but it is also a deliberate strategy. By focusing on a smaller geography, branches stay tightly clustered, staffs can be trained uniformly, legal processes are predictable, collateral valuation norms remain consistent, travel distances are small, recovery discipline is strong. For a lending model that depends on local familiarity, staying concentrated improves performance. Expanding too widely, quickly, would destroy the economies. 5 Star grew concentric circles, not random jumps, a key reason for its stability. How 5 Star scaled without losing discipline. Number 1. Same product plus same segment equals to scale with consistency. 5 Star did not diversify into vehicle loans, consumer loans, MFI, LAP for high-income borrowers, SME loans. The company stuck to one product, one borrower segment, one underwriting playbook. This consistency created scalability. Number 2. Branch network grew steadily, not explosively. From the extracted timeline, 39 branches in FY15, 100 branches by FY70, 520 branches by FY24. This is measured expansion, not reckless expansion. Number 3. AUM grew with controlled leverage. With expanding, 5 Star maintained high capital adequacy, moderate leverage, controlled risk metrics. Number 4. Natural adjacency expansion. The company expanded into new districts only after saturating existing clusters, training local staffs, understanding economic patterns, building recovery infrastructure. This is the opposite of the growth of all costs model. Financial performance. What the numbers show. Based on historical disclosures, NPAs consistently low. Gross NPAs usually around 1 to 1.6%, net NPAs less than 1%. High margins. Small ticket, secured business loans carry naturally higher yields. Strong profitability. A combination of high yields, low credit costs, conservative operating model, low LTV collateral, high collection efficiency. Allows 5-star to generate high ROA and healthy ROE, even without excessive leverage. Customer stickiness. Repeat lending is high. BT outs are low despite no foreclosure penalties after 12 months. This indicates strong trust and competitive differentiation. Why competitors struggle where 5-star succeeds? Number 1. Banks. Banks finds this segment too operationally intensive. Underwriting here is human, not document-led. Number 2. MFIs. MFIs lend to groups and largely unsecured. They do not handle small business secured loans. Number 3. Classic LAP NBFCs. The ticket size is much larger. Their borrower base is different. Their operating model is centralized. Number 4. New age digital lenders. They cannot replicate field visits, neighborhood intelligence, local staff, physical collateral assessment. The gap is not digital. The gap is local presence. 5-star's dense branch network gives it ground truth, not just data. Risk factors. The main risk disclosed historically. Geographic concentration. A downturn in any of the 4 major states affect the book. No SARFAESI access. As an NBFC not covered under SARFAESI for small ticket home secured loans, recovery relies on negotiation, arbitration, customer relationship. Customer vulnerability. Borrowers are micro-entrepreneurs with modest incomes. Economic shocks can impact them quickly. Operational intensity. The model depends heavily on staff quality, branch efficiency, local knowledge. Any dilution here affects performance. The real reason 5-star became a leader. 5-star did not win because it's built better technology, or better analytics, or better marketing. It won because it built a denser branch network than peers, a deeper presence inside neighborhoods as in-house relationship-driven model, a specialized underwriting playbook, and a single-minded focus on one borrower segment, a conservative, secured product. And most importantly, it understood India's smallest entrepreneurs better than anyone else because it lived where they lived and worked where they worked. In NBFCs, the real competitive moat is not capital, not technology, not pricing. It's proximity plus discipline plus consistency. And 5-star built all 3 earlier and more effectively than most lenders in its space. Outro. This is the story of 5-star Business Finance, a company that identified a massive credit gap long before anyone else, built a hyperlocal lending engine and created a model so operationally tight that even banks can't replicate so easily. If you would like us to analyze similar companies in MSME finance, housing finance or other high-touch lending model, tell us in the comments. And don't forget to like, share and subscribe to India Business Insights.